Hey everybody, it's Ken here. I'm very excited to have Brent Johnson of Santiago Capital here. Brent, welcome.
Thank you. Thank you. Thanks for having me.
I got a chocolate milkshake here. Let's start with what is the milkshake theory?
So the milkshake theory, well, I guess I should take a step back and let people know. I mean, my job is to manage money for other people. So I have a fiduciary duty to go out there, protect clients' nest egg or the money that they've given to me. My job is to kind of protect them against hidden dangers and then also try to grow it in a prudent manner over time. And so, as much as I try to make money, I'm always trying to protect it as well. And I'm trying to find these hidden risks that could come out of nowhere and, hurt clients because I started in this business in 99. And so about every 4 or 5 years of my career, there's been a crisis. So I'm always on the lookout for what could go wrong. And, it was back in 2018 was the first time I ever used the milkshake theory language. And that's when I started explaining how I thought a global sovereign bond and currency crisis would play out. I think a lot of people know that there's a lot of debt in the world. And every time we get into one of these crises, the way the governments solve the problem is they kick it down the road and they ultimately make the problem bigger, but they kick it down the road and we deal with it at a future date. And then it happens again and again. And so one of the popular theories of how the US government will ultimately solve this problem is that they will inflate the dollar away. They will have to print so much money that the dollar will lose value and the US dollar will go through hyperinflation. It won't be worth anything anymore, and the US living standards will fall versus the rest of the world. And it's generally seen as kind of this is America's Rome. We're going to be similar to the fall of Rome. And the reality is when you take a look at the United States in isolation, it's pretty hard to come up with a conclusion other than that because we have made a lot of mistakes. We have taken on a lot of debt. And, the end game doesn't look great when you just study the fundamentals. And so when people come to this conclusion, it's not that I think that they're necessarily wrong. It's just that they don't have the whole picture. And what I mean by that is they're not looking at the world as a whole. They're just focused on the United States. And I used to be one of these people who would talk about how the dollar was going to fail and there was only one way, and that was to print the money and it was going to lose its value. And again, it's not that this is a wrong conclusion, but I came to the realization kind of in the 2016, 2017 timeframe that I was looking at it way too myopically. And I realized when you did the same deep level of analysis on Great Britain, they had just as many problems. And when you did it on Europe, they had just as many problems. And China had just as many problems. And Japan had just as many problems. And South Africa and Australia and Brazil. And once you stop just focusing on the United States and you realize that everybody's kind of in the same situation and they all have these big problems associated with too much debt, then you realize, well, it's bad, but it's bad for everybody. But then you also realize that the rest of these countries don't have all the advantages that the United States have. Post World War II, the United States was set up as the global hegemon, the global leader, the global superpower. And many of the international institutions and the way the world really works on the global stage was set up to favor the United States. And so if you want to say that that's how they rigged the game, I don't necessarily have a problem with that. Or if you just want to say that's how the free market developed over the last 100 years, I don't have a problem with that either. But that is the reality of the situation, is that the U.S. has many institutionalized advantages that the rest of the world just doesn't have. The biggest being the dollar is the global reserve currency. And so the milkshake theory is based on the saying came from a movie called There Will Be Blood. And it's a very famous movie. Daniel Day-Lewis is the lead actor. I think he won the Oscar for the role. And he's this really kind of this cutthroat oil baron, and he's negotiating a piece of real estate with his neighbor. His neighbor wants to sell him the land. And he says, if you buy my land, you get all the oil that's underneath it. And he says, well, I would like to have your land, but I don't really have to have your land because I could just stick a straw down into the ground on my side of the fence and I can suck up all that oil that's on your side of the fence. And he says, I'll drink your milkshake. And so what I was saying earlier about the way that governments typically deal with their problems associated with debt is they kick it down the road. Well, the way they kick these problems down the road is they print money, they flood the market with liquidity, they do bailouts, they do stimulus plans. However you want to describe these monetary arrangements that governments always come to when they're kicking the can down the road. And to me, that's mixing the milkshake. That's providing the world with liquidity. But because we're such a globalized economy now, and it's not just restricted to domestic economies, that capital, that liquidity can flow all over the world. Now they're starting to put up roadblocks to kind of stop this flow, but as it is right now, capital kind of flows where it's treated best. It's like liquidity. It just goes where the gravity takes it. And for a lot of reasons, that the financial gravity takes capital to the United States. And one of my points was that because the U.S. is the global reserve currency, because we have the deepest capital markets, because there's so much demand for dollars outside the United States, and come to that in a little bit. That's the euro dollar market. That's a big key. Because of this euro dollar market, there's so much demand for dollars that in a crisis, everybody needs dollars. And so even if the U.S. has problems, Brazil has bigger problems, Europe has bigger problems, Russia has bigger problems, the world as a whole will flock to the dollar in this crisis. And that's the dollar sucking up that global liquidity, that global milkshake. And that process of pulling that liquidity into the dollar makes the dollar stronger on a relative basis versus all these other currencies, because currencies trade relative to each other. You might think about it, if you're on the playground and you're going to play pickup basketball game and you've got 10 players, even if all 10 players are absolutely horrible, one of them is going to be the best player, right? And so if you think the dollar is a horrible currency, I won't argue with you, but it's just a better player than the other 9. And so it will get picked first, in my opinion. And in that as that capital flows into the dollar, it makes it stronger. The reason this is such a problem is the rest of the world over the last 50, 60, 70 years has taken on a lot of debt of their own, but they've taken on a lot of debt in US dollars. So not only do they have debt in their local currencies, but they have debt that's denominated in dollars. And that is a problem they can't kick down the road because they can't print dollars. They can print their local currency, but they can't print dollars. Only the US can, quote unquote, print dollars. And so as the US dollar gets stronger on a relative basis, that makes that debt for these foreign countries harder to pay off. And it makes them have to print even more of their currency to try to get out of it, which just exacerbates the problem. And so I think you get into this kind of this doom loop where dollar strength begets dollar strength. And the last thing I'll say, and that is, and then I'll stop rambling, is that as the dollar, if the dollar starts to fall, a lot of times people will say, well, see, there's the dollar falling. It's had its peak. It's going to go lower now. They're printing all this money. But the reality is as the dollar falls, that's the central banks getting what they want. That's the system perpetuating itself. Because if the dollar is falling and it's abundant, then the global economy can continue to operate as it's designed to operate. It's only when the dollar spikes and becomes hard to get and causes defaults and causes illiquidity, that's what causes the crisis, is the dollar going higher. So if you think we're going to have a crisis, maybe you don't realize it, but then that means the dollar goes higher. And so if the dollar doesn't go higher, there's really no crisis. So that's the milkshake. And that's what I think is going to happen in the years ahead. I think the dollar will get stronger. I think on a relative basis, the U.S. markets will outperform the rest of the world. I think gold, real assets will probably do well as all fiat gets debased around the world. But I think the dollar does better on a relative basis.
In one of your videos, you said there were 3 main pieces to this dollar milkshake. One is that the U.S. dollar will continue to strengthen, which has definitely happened. 2, we'll get into some global trouble. And 3, the reaction will be a currency crisis. So where do you think we are in those 3 places?
I know the first time I mentioned it was the summer of 2008, and I talked about in the years ahead how I thought this would play out. And I said I thought the US dollar would go higher, I thought gold would go higher, and I thought US equities would go higher. But that they would all be characterized by terrifying drawdowns along the way. And so if you go back to 2018 until now and you chart those three things, you will see that all three of them are up. Dollar's up 25%, gold's up 20% or 25%. Equities are doubled since then, or not quite doubled, but close to a doubled since then. But there's terrifying pull downs along the way. And that is because as the dollar gets strong, it causes these defaults. And when defaults happen, liquidity disappears and you get these cascading markets down. And then the governments come in, they respond to it, and it pushes the market higher again. And so I think that those are kind of the keys to it. Is that you kind of got to understand that assets tend to go up and to the right because fiat gets debased over time. But you can't just sit there and hold them all the time because of these drawdowns along the way. If you knew that fiat was going to get debased, you would take out as many debts as you could. And as it gets inflated away, you pay it off over time with fewer dollars. If you knew it was absolutely going to just go in a straight line, that is 100% what you would do. The problem is these sharp drawdowns along the way. If you're over leveraged and don't have enough liquidity in those drawdowns, then you might end up becoming a distressed seller rather than a distressed buyer. And so I think that's one of the key things, is that even though, we are in a higher inflation in market, I think you need to hold some cash or some liquidity on the sidelines to be able to get through those drawdowns. So where we're at today, I think we're kind of on the verge of another one of these sharp drawdowns. And so I think in the years ahead, the dollar will be higher. I think equities will be higher. I think gold will be higher. But I think we're probably going to have one of these drawdowns sometime in the next 6 months.
So what's the definition of a drawdown then?
Yeah, no, I mean, I think anything. Well, you can have a couple different types of drawdown. You can have a V-shaped drawdown, which is what we had in COVID, right, where it just down and then immediately rockets back higher. Or you could have a U-shaped where it drops, stays down for a year or two, and then goes back up. I'm not smart enough to know exactly which one we're going to get. But what I do know is that if we don't have a crisis, then it will be because the dollar is staying at this level or going lower, and assets are going up and to the right. But I have a chart that I think I showed you in the Bahamas that if you look at the last 25 years, every time there's been a crisis, it coincides with a stronger dollar. Now, whether the dollar going higher causes the crisis or whether the dollar goes higher in response to the crisis, I don't know. I think that could be a pretty good debate. All I know is the correlation is 100%.
What can people do to prepare for, these next few years? Because it looks like to me that some of these other countries that are tied to the global financial system, or their dollars or euro dollars, is going to start spilling over to the U.S. at some point.
This is going to be very general advice because everybody's kind of unique and everybody has their own specific needs and goals and desires. But I think in general, I think this is a period of time where I think a lot of times when people get scared, they do nothing. And I don't think this is a time to do nothing. And so I think what you need to do is you need to kind of set yourself up to be prepared for everything. And there's a couple of ways you can do that. Number one, if you have a job right now, don't quit it. Unless you have a sure thing, maybe you have a great idea, you're starting your company and you've been saving up to do it and you see the opportunity, maybe you do that. But if you're just sick of your job and you don't really want it anymore and you'll find another one in 6 months, I wouldn't do that. If you have a job, keep your job. Number two, if you have the ability to save some on the side and put like a little bit of just cash on the sidelines. I know that a lot of times in a inflationary environment, people will say cash is trash. You don't want to hold any cash. I get it. You don't want to have all your money just sitting in cash, but having some cash on the sideline does a couple things that are extremely important. Number one, it gives you liquidity to where when that crisis comes or when that drawdown comes, you're not the one looking for liquidity because you already have it. You have some liquidity. If you don't have liquidity and you're all in on whatever you are and that drawdown comes, you might have to sell some of whatever you own in order to get liquidity, in which case you become a distressed seller rather than a distressed buyer. You never want to be a distressed seller. You always want to be a distressed buyer. So having cash on the sidelines allows you to do that. Even if you're losing a little bit versus inflation while that cash sits there, I think over time, it'll more than make up for it, because if we get a drawdown and you have that liquidity, you can go buy a really good asset for pennies on the dollar or dimes on the dollar. And as it appreciates, you'll make more than what you gave up due to inflation over that short-term time period. The other thing that cash on the sidelines or some kind of liquidity on the sideline provides is it provides peace of mind. In other words, if you're fully invested and now we get into a stock market downturn or an economic downturn and everything's going against you, you are going to be stressed. And if you're stressed, you're not going to be thinking clearly. And so, but when a crisis comes, that's when you need to have clarity. And that's when you need to be thinking very rationally. If you don't have liquidity, you're not going to be thinking rationally. But if you already have prepared for it and you've got that liquidity on the sideline, you can sit there and look around for an opportunity when everybody else is freaking out. So I think it's really important to have some kind of cash on the sideline or some kind of a hedge that protects you against one of these drawdowns. The other thing is I think you should have some exposure to assets, because we're talking about fiat currency gets debased over time. I don't know for sure that we're going to have this crisis tomorrow or next week. And I think over long periods of time, assets go up and to the right and fiat currency gets debased. So you want to be in appreciating assets. So whether that's, productive real estate, that you have a good beat on, if it's some kind of large cap U.S. blue chip stocks that can weather a recession, maybe it's gold, maybe it's some other type of a real asset. I think you need to have some assets in something that will appreciate over time as fiat gets debased. And then finally, I think this is going to sound a little crazy, but I think one of the most important things you can invest in over the next year, or maybe even the next several years, is some kind of a local community network of like-minded people who you can talk to and help get through, because it's going to get crazy. And not just economically, like socially, it's going to get crazy. Politically, it's going to get crazy. And I think you need to keep an open mind. I think you need to figure out a way to talk to people who you vehemently disagree with, because if you don't learn how to talk to them and cooperate with them when things are calm, you sure as hell aren't going to be able to do it when things are crazy. So this is a long way of saying, try to keep a level head and be prepared for everything. I wouldn't go all in on anything right now. I think a lot of people are all in on Bitcoin or all in on gold or all in on real estate or all in on stocks. I very much believe diversification is important. And then when you see the opportunity, you can go overweight or you can make a big bet on something, but don't just do it blindly right now because you're 100% sure that you're right. I don't think anybody should be 100% in on anything.